big improvement on many fronts. So overall, we're satisfied with the result, but there's still a lot of work to be done. But everything's moving in the right direction.
Well, tell us a little bit about the recovery. Has it been predominantly market-driven, or is it a matter of management intervention over the financial period?
Eleni, I think the markets obviously played a role. A big portion of our earnings are derived through our balance sheet, and clearly when markets improve and do well, that's very positive for our earnings. But I think the key takeout from these results is the improvement in the operational performance of the life business. So the difficulties that we were having from a persistency perspective have kind of been overcome, and I think that's the highlight.
Well, looking at those lapse rates or persistency levels, you have alluded to the fact that we've seen quite a big improvement, but you're also looking at the value of business that you've been getting in, and as a result we've seen lower volumes coming to the fore, and we've also seen margins coming under slight pressure, coming through at 1.2% versus the December 2009 period. Tell us a little bit about that mix and how you plan to address that going forward.
Yeah, Eleni, inevitably when you focus on the quality of the business that you're writing, you turn away poor quality business, which means that you have lower volumes, and when you have lower volumes of business and your cost base remains reasonably static, it impacts margins. But we're comfortable that we've set the right base from a volume perspective, and we're comfortable that we can grow the volumes at the right quality, and that over time those actions will address the margin issue that we face right now.
And looking at the margin issue, as we've just mentioned, one of the reasons that perhaps they did come in slightly lower is because also, as you mentioned, the conservative assumption that you have for that financial period. If you had to take perhaps a different scenario and say, well, if you adopted similar assumptions to that of prior to the crisis, what kind of margins would we have seen?
Eleni, it's difficult to be specific, but the margins would look a lot healthier. So I think if we were writing the current volume, the current quality of our business, and reflecting in the assumption, the actual experience we're seeing now, the value of new business would be quite a lot higher and the margin would be a lot higher, but we're not yet comfortable to change the assumption. And we always said to the market that we would only consider changing the assumption at the end of 2011. And obviously, if we're able to do that, you'll see a recovery in the margin.
Well, that's quite interesting, because we have seen a recovery overall in South Africa, consumer looking slightly better. Yes, there are risks at play here. Why are you adopting this conservative assumption and only changing it towards the end of 2011, going into 2012? What are you waiting for?
Eleni, I think if it was just a normal business person, we would probably change the assumption. But what we have to do, we're required to do in terms of the statutory actuarial requirements, is satisfy the statutory actuary. The statutory actuary needs to have a certain level of data comfort, and from his perspective, he needs a bit more time.
We know that the value of acquisitions has increased. Tell us about the cost of acquisition, because that is still one of the big bugbears, it seems.
Yeah, I mean, so the issue with the cost of acquisition, it isn't that we've spent more money. It's just that we've spent the same amount of money with fewer policies coming in, and so you spread the cost of acquisition amongst a fewer number of policies, and therefore the cost of acquisition per policy goes up. So if we can get the overall number of policies up and at the same time reduce cost, you'll see a dramatic increase in margin.
Let's touch on your property offering. Returns for property portfolio in 2010, 11.9%. Looking at the overall listed property scenario in South Africa over the 2010 period, we saw a return of around 24–25%. You did underperform the overall listed property, but we know that you have offered the market double-digit returns for many years.
Yeah, Eleni, I think the key thing is to understand it's a different offering to our property offering is a different offering to the listed property offering. What we have promised in our offering is inflation-beating returns, and we have successfully delivered inflation-beating returns for the past 27 years. So it's a different, it's kind of an indexed, linked inflation-linked offering as opposed to a pure market return offering, and we're delivering on the promise.
Let's switch gears a bit. Talking about Africa, you alluded to it a bit earlier when we were talking about the medical offering and the health offering. We know that you are springboarding off the likes of Stanlib. They have said they're not going to be going into Africa as aggressively as before. Does that change your game plan at all?
Not at all, Eleni. I mean, we said we wouldn't really go into Africa unless we had an opportunity to do so on a basis which meant that we had less risk than our competitors would have if they were going in alone. And Standard Bank offered us that opportunity. And we have a presence in 12 countries. I think that's enough for the time being. We've got a lot to be getting on with. We've made some acquisitions and we need to bed those down. So, I don't think we need to be taking more on board at this stage.
And tell us a little bit about CFC Insurance. It's a very exciting space when you look at the overall insurance industry, especially in East Africa. It's gaining traction. It is all about product innovation, and that deal is set to be concluded quite soon.
Yeah, it's taken us a long time to get the CFC deal done. I think we started the discussions in around about 2007. And it's been frustrating, the whole of the regulatory reasons for us not being able to conclude the deal on time, but we're expecting it to be concluded towards the end of next month. So yeah, I think it's not a huge investment, but it's a reasonably sized investment, and I think it gives us a platform off which to play in East Africa.
Taking a look at Stanlib, and we know that during the really good times, Stanlib outperformed the market. When things turned, we know that we saw a lot of pressure coming through at Stanlib. Things are turning around there, and that's under the management of Mr. Glotty. Tell us a little bit more about how Stanlib has been performing, and perhaps some of the risk scenarios that are going to play out going forward as well, and how you've changed perhaps that strategy.
Yeah, Eleni, we in 2006 we kind of took the view that we needed to get into asset management, and hence we acquired Stanlib. But we always recognized that we needed to have an asset manager that wasn't a captive of an insurer. It needed to be a genuine third-party manager, and we introduced a boutique asset management model, and that, we had some difficulties with that in 2008 and 2009. We brought Thabo on board, and the idea is to continue with that approach. We want a genuine third-party asset management business that is multi-boutique in character, and Thabo has successfully driven that approach. I think he's brought leadership, he's brought stability. Together with Stuart Ryder, the CIO, they've introduced all the necessary risk and process improvements to make sure that we deliver what we say we're going to deliver to clients, and you can see it coming through in the performance. So the number one in the large managers watch survey, number 3 in the local manager watch survey, a number of awards being won, and you can see it coming through in the cash flows. 16 billion of positive cash flows is not insignificant in anybody's book.
To end off, looking at the year ahead, there are various risks on a global front. Here in South Africa, we could face an interest rate hike, we could face looming inflation, all of which is going to affect the consumer and perhaps some of your product offerings as well. What is your biggest risk factor right now going forward into 2011? What is perhaps keeping you up at night?
Eleni, obviously the macroeconomic environment is a concern, but one can't really do anything about that. The real challenge that we face in business is making sure that we deliver what we said we were going to deliver. And that is really about getting your operations right, making sure that your people are doing what they're meant to be doing. And that is an everyday ongoing challenge.